Monsieur le Président, cher Monsieur, Mr. Rasinger, ladies and gentlemen, I have the task to speak about the Euro, a success story. This is perhaps a daring title for this speech because I'm sure that some of you think the Euro is a failure, especially if you're coming from Great Britain or the United States, which obviously is not the case. But let me say the first thing. The Euro is really a success story, and in the next 25 minutes, I'm going to explain why, and I give you the reasons why you should think the same way. Because the Euro, we pay in Euro, we save in Euro. I will show all this. The Euro helped us in the development of growth, helped especially Austria and Germany in achieving a surplus in the balance of payments. And the Euro is, of course, after the dollar, and you will see how it grows and grows, the second reserve currency when you think on the worldwide trade. So this is the introduction, what it is going to be. Depending where you are from, you will not agree on all points, but this makes sense since we have here a discussion. I will also talk about what the Euro still needs to remain a success story. Now my first chart gives you the quick look at the history. Excuse me, I have a little bit of a cold, but not because of the Euro. We started in 1990 with the abolition of all restrictions on capital movement. You know, the four freedoms: movement of capital, movement of labor, movement of goods, and having the possibility to start your business wherever you want. The second step was the European Monetary Institute, which was the predecessor of the European Central Bank. And in 1999, we had the fixing of the conversion rates. This was the virtual euro, so to speak, and the physical euro was then in 2002. Just one point, one country did not join in 1999. This was Greece. Greece joined a year later in this fixing of the rates, because the Germans, when Raidl was still finance minister, was strictly opposed to Greece because, in his opinion, they didn't fulfill the criteria or the requirements. And then, as you know, the government changed in Germany, and then Greece was allowed to join. The next chart shows you the 17 countries. This is the yellow. And we will be, as of 1st of January 2014, we will be 18, because Latvia is going to join. They fulfilled all the criteria and they will join. So we will be out of the 28, we are now not 27, but 28 EU members because of Croatia. So the difference will be again 10. It's 18 to 28. Now I give you three charts where I want to show you on the example of Austria. I will then move on to other countries because Austria is not that important. I will show you the positive effects, or as I said, the success, how we benefited from the euro. The first point I want to say is lower inflation for the whole euro area. The European Central Bank said in 2002, our goal is an inflation close to 2%, but below 2%. And when you take it from 1999, the fixing, or 2002, we had an annual inflation in all the euro countries, the eurozone, of 1.9%. So this was fulfilled. We had, as I said, especially Austria, we had a growth rate above average, which was, of course, mainly due to the euro, because the euro helped us to increase our exports for two reasons. The first was our main competitors, when you take Italy, never had the chance to get an advantage through devaluation, what they always did. Especially I come from the steel industry, as you know, and the small steel companies in Italy, in Lombardia, in that area, when they were very easy on their wage increases, because they were not like Austria or Germany, where the increases were rather flat when you take the unit costs. labor unit costs. You know, they were, as the Americans would say, happy-go-lucky. But then they were not competitive anymore. They devalued, and we all had the problem. So this helped us. And the other thing I wanted to show you, the interest rates did go down, as well as for corporate loans, as well as for loans to households. The interest rates went down. The most profitable downturn in interest rates was, of course, for countries in the south, like Greece. Because before the euro, the Greece paid already 7 or 8% or what have you. Then came the euro, because the investors then thought euro is euro, and they all got about the same rate, not the same, because the benchmark is the 10-year German bond. And you always had a spread to that, but not, as I will show you, in case you can see later on. And so the interest rate was also a big success. The third, that's the second. The other one is that I said already we had a big advantage in our exports. Yeah, and the other reason in our exports was that the Austrian shilling before 1999 was fixed to the German D-Mark. And you know, the German mark was a very strong currency, strong in comparison to the US dollar. And when you have a hard currency in your external value, to remain competitive, you have to keep your internal costs low. And most of this is labor costs. And we were, as I said before, in our labor costs, very competitive. And since the euro in relation to the dollar is softer than the old German mark, we had, of course, a big advantage in our external performance. And when I went to school, we learned Austria is a small country, and you know all the disadvantages of small countries, can never achieve a surplus in the balance of payment. But we did achieve, and now we are on the line again, on the track. This shows you the growth differential between Austria and the euro area. The red thing is Austria and the blue one is euro. You see that we did better than the average of the euro area, which is, of course, when you consider the southern European countries member in the eurozone, we all had, of course, in 2009, we all had a downturn. Austria about 3.5%, Germany minus. Germany about 4%. We all had a downturn. But then when you see how the red curves develops, this is the Austrian curve, develop better than the average. And on the right-hand chart, I say what you see. You see the real GDP per capita, and you take the euro area as 100, and how did Austria perform when the euro area is 100? So we're always better than the average. On the next chart, here, this is a very interesting chart for a small country. I'm sure it will be the same for the Netherlands and for Belgium. But here you see how through the euros, the green area enlarged, and the green area is Central, South, and Eastern Europe. You know, where all the banks went, and Austria was really, or also the insurance companies. And I don't say this because the CEO of this wonderful insurance company, where I'm also insured, this was a short advertisement. No, seriously, we Austrians were the first in the banking sector as well as in the insurance sector to move to this area, and this is the green line. I don't go into the other details. In the green line, and you remember in 2009, 2010, some of the American, even professors and analysts and what have you, said this is the biggest danger for Austria, because they took all the exposure, and talking only about the banks, they took the exposure of the Austrian banks to this area, and this was around 300 billion, which is exactly one year's GDP of Austria. And then they said, oh, it's all horrible, and you know all this. They did not, the analysts and the rating agencies, well, they're also analysts, a type of that. So they did not differentiate between, for instance, the Czech Republic and Romania, or Bulgaria, or the Slovak Republic, between some other countries. When you differentiate more, you would have had even then a different picture and conclusions. Now, Moody's, about 2 weeks ago, they made an analysis again, and what did they say? How good it is that Austria, and especially the banks, have such an exposure to this area, because this is the growth area within Europe, which is true, I mean, that this is the growth area. The other things I don't talk about. But here you see the success. Now is the next chart. And here, because of this exposure to Central and Eastern Europe, I thought it's good to show you how Austria benefits from the catching up process in the Central and Eastern Europe. Because when you look at the Eurozone, the 17 or next year 18, we have this year most probably a negative growth rate. When you take the whole European Union, we have a positive growth rate. And why? Because this area contributes so much that the negative growth rate, or shrinking of the economy, of the Eurozone is made up by the growth rates of the Central and Eastern and Southeastern European area. And this shows it. This is the difference, and this explains also the difference between the European Union 27, so that's the red line, and the blue line is of course above. This is just the European growth, the euro area. So I talked about price stability, and I show this on the next chart. Yes, here you see the harmonized index of consumer prices. And here you see the overall and different core inflations. It's difficult to see, but you know, you take the whole inflation or the consumer price index, and then you take out energy and unprocessed food, that's the red one. You know, you differentiate. And we in Austria now have a discussion how we settle and put in different services and goods for measuring the inflation. We have a special index for people who are retired because their needs are different. It's also a political instrument a little bit, you know. I once said, why doesn't every party for its member make an index for political discussions? But this is according to teaching also. You can take out energy and unprocessed food. You also can take out tobacco, alcohol, and things like that. But the message is that the Eurozone, since the introduction of the euro, achieved what the central bank said, an inflation close to 2%, but below 2%. Now, what I said at the very beginning, euro's growing international role, that's the next chart. Here you see, when you take the right chart, it's in percent, the violet or what, pink or whatever it is the dollar, and the blue is also already the euro. That's the right chart. There's an international reserve currency or reserve assets. You see that the trust in the euro is increasing. For instance, when you take this chart, the trust is increasing. The other currencies is the Swiss franc, the Japanese yen, and of course the pound in Great Britain. But you see the euro, and you have of course here more denominated in euro than you have actual trade coming out of the eurozone. But it's increasing. Of course, the US dollar is still dominating whatever they do with their household policies over there in the States, but the dollar is still, and it's really interesting when you look at the debt of the United States in percent of GDP or whatever you take. It's interesting that the trust in the dollar is not decreasing, and it is the dollar. Of course, the Americans, as just one Nobel Prize winner who was in Vienna, I think Monday, Tuesday, pointed out, the US dollar has or the United States government has one big advantage. They can print dollars in case they need them. Because, you know, it's a different statute compared to the statute or the bylaws of the European Central Bank. So the next chart shows you how all our smart people in economics change their opinion. This is why I like this chart. Here you see the assumed growth rate for 2013 in November 11. That's on the left-hand side. You know, people thought the growth rate in the euro area in 2013 will be 1.4, 1.3%. And the closer you come to reality, the lower is the growth rate, because you come to reality. So here you can call this the collective errors of all forecasting institutes. So. But we are picking up to end up more positively. We will have in 2014, we will have for the euro area, for the European Union, also Germany, Austria, of course, we will have positive growth rates. Austria will have this year about 0.5, next year 1.5, 1.6 or so. Also perhaps it declines when you look at that chart, but perhaps it goes once the other way. But this shows how firm forecasts in the economic business are. Now here, first of all on this chart, look at the end, it goes upwards. That's the good message. But you still have a differential. The red line far above is China. China, you know, it starts from 2005, you know, when China was way above 10%, and now it will be around 7 or what have you, where people say this is a problem for China, and how can China shift the economy from an export-oriented economy to a private internal consumption-oriented economy, which is, of course, their main problem. But when you look at the green line, that's the next one, when I go from above to the world. So the world, you know, it all goes up, a little bit of a hockey stick. So, but I hope it's not the collective error again. But when on the right-hand chart you have this is a very interesting, and it shows you the social problems we have in Europe. And the next chart will even show it more clearly. When you look at the euro area, and I took 2008 is 100, and 2013, and when you look at the euro area, we are below 100. That means our GDP in the euro area, I will show them the different countries so that you see the social tensions in those countries. When you look at the euro, we have not reached yet the level of 2008, 5 years ago. The other countries, the United Kingdom closely, Japan above, United States above, and China, of course, they had every year growth rate. So when you compare China 2008 to 2013, they are in the index 142 or whatever, and the euro area is below. And when you look now at the different European countries in the euro area, this is the next chart. When you take the right hand, you see Greece, that's the red. This is not a political marking, just for your eyes. When you look at Greece, they have a GDP, and this shows everything. On political discussion, tensions, problems, they have a GDP of around 77% of 2008. So they are 5 years after the crisis started. They are still below 2008. And of course, we all remember the measures, decrease salaries and reduce public servants and all the things we read in the paper every day. But here you can imagine what that means, that when you now also take, it's a growing population, I don't know in Greece, but let's assume it's a slightly growing population, it's even tougher when you then take it per capita. And then you have Portugal, Italy, so you have a lot of countries below, below 2008, and there you have the average again, that is what I had before, and then you see the countries that are above, for instance, Austria, Germany, and I can't read, Sweden. So here you can see I mean, it's a very sober chart only, but when you look behind it, what it means to have a GDP 5 years after the crisis still way below before, that's a big problem. So I just point out you can do your own philosophies on this. Now, the fiscal policy, and I said I start with Austria and then I go to the international thing. The fiscal policy in an international comparison, you see here the budget deficits, you know, for the euro area, the famous 3% and 60% of public debts. Nobody achieves this. And here you see how the different countries are performing. Of course, 2009, this is the big dip. That was the crisis year. States, sovereign debts increased mainly for 3 reasons. The states had to refinance the banks, had to start social programs to fight against the depression or shrinking economy. And the third is the so-called built-in stabilizers. You know, when the economy goes down, unemployment benefits goes up, which is, the economists call that the built-in stabilizers to keep the economy a little bit even. And here on the right hand, you see the public debt ratio, which should be the famous 60%. The big thing is Japan. Japan is about above 200%. The good thing in Japan is, I think still true, about 90% is internal debt. So they're not depending on foreign investors. The United States is the next, that's the pink or whatever, on the graph. So United States have also reached now above 100%. The euro area is below 100%, as well as the UK. So this shows what it is. Now I have a couple of charts to show what has to be changed in the institution. I will go through that. You know, when you have a crisis like this, everybody calls, we have to change, more regulations, Basel III, solvency ratios for the insurance companies, more surveillance and more people in the ECB, and in the next life we should all become regulators or corporate governments, codex people. But to be serious, you see here the institution building in the European Union and in the European Monetary Union. The crisis at the European Financial Stability Facility, now the ESM, the European Stability Mechanism, where they have hundreds of billions, you know, to invest and help money, so to speak, European Monetary Fund, something like that. Then we have the 3 surveillance authorities. You have the European Systemic Risk Board. Then you have the EBA, the European Banking Authority, sitting in London. Yeah. Then you have the European Securities and Market Authority and the European Insurance and Occupational Pensions Authority, one in Paris and one in Frankfurt. So that's Europe, London, Paris, Frankfurt. In every other country you would have that in one city, but that's the way it is. Then fiscal policy, stability and growth pact, you have all read that. And structural policy, you know, we have these excessive imbalance procedures when you are way above, no, not way, a little bit above the famous 3% in your annual deficit. In the next chart, this is what I said before, how are the spreads developing. And here I start with January 2010, and the lowest is Germany. Germany, as I said, you always take the 10-year government bond. Yeah, it says anyway, the 10-year government bond. And here you see the tremendous spreads. I mean, the green one here is Portugal. You have Austria is rather close to Germany, thanks God. We are very low. But, you know, I don't want to mention countries not to hurt anybody's feeling or to say something politically incorrect. But The good thing is the spreads go down, and it's now coming to a positive thing. This is the next. This is a very interesting chart. It shows the surplus, imbalances, current account. I just go to one country that you can see what the country can do. Germany, it's here Deutschland. Germany was in 2000 negative in the balance of payments. And now look at the development. This is all Germany. Austria is also up there, and Netherlands and some others. Why did they achieve such a turnaround? Of course, the euro helped, as I said at the beginning. But the other main factor was the reform introduced and executed mostly by Chancellor Schröder, the Agenda 2010. You know, with all this unemployment and Hartz IV, I don't know how far you are familiar with the Germans. We are, of course. And here you see what a country can do with reforms to get more competitive. And the question is, how can Greece, France, etc., get more competitive? And you have, and what did the Germans do on the labor market? A lot of reforms. And without calling a country, but when one country reduces pension age, and Germany goes up on pension age, or when one country says when you start employing, you can't fire him or make him redundant, to be more polite, in the first 2 years, how can these countries be competitive? So I could give you a whole list, but this graph shows very well where the problems are and where the successes can be. Then the unemployment rate in the euro area, you see unemployment in total, and then you have the youth unemployment. The squares are the youth unemployment, and when you look, you know all the countries here. In some countries, you have youth unemployment. Spain, for instance, above 50%. Youth defined 15 to 25 years of age. And this is, of course, but this is not the problem of the euro. No, it's not the problem of the euro, it has some other things. Now, my last chart, after I have, I think, mixed up a little bit your timetable, for which I apologize, but you could have stopped me, so I'm in your hands, and you are not in my hands. So, but the last chart, why European Monetary Union, economic and political reasons. We all know the pursuit of peace and growth, or the pursuit of happiness in the US Declaration of Independence, or a common currency symbolizes unified Europe. I think I do not read all this, but let me say one thing. What we have learned within the European Union, one thing, and this history proves too, a monetary union only works when you have a political union. What does political union mean? You need one European or European area, euro area finance minister, you need one economic minister, and this means that a lot of sovereignty of Austria, Germany, all the member states, has to go to a central unit. Otherwise, a currency union does not work. There's a book that analyzes 12 currency unions, the Latino, the Scandinavian, by the way, which broke up in 1923 or something, because they never had a political union. And there's one example, there are others, but one I always take is Germany in 1871, when Bismarck formed the German Reich, the German Empire, das Deutsche Reich. It took him 5 years. And you know, there were 42 kingdoms, duchies, and whatever they called themselves, 42 countries, or 44, that formed the German Empire in 1871. And it took him, I think, 5 years. And he was a strong person, stronger than those sitting in Brussels, I suppose. And it took him so long. So the lesson, you know, they always ask lessons learned. The lessons we have to learn is we need a political union, and I know how difficult it is, because in Austria and in Germany and in Switzerland, no, Switzerland is not member, in Netherlands, you win elections when you're against Europe. 25 years ago, you won elections when you were for Europe. Thank you very much. I'll leave it.